bringing Kurt Nelson on, to bring the founding partner and CEO of Summerhaven Investment Management here on the show this morning. Kurt, good to have you with us. Central banks, the focus here. We started off the show talking about how ECB was expected to cut. They did. A similar situation with the BOC yesterday. Both of those were highly expected. The Fed's likely to come next, right? When do you see that first cut from the FOMC?
Well, I think there's been a huge change in expectations of the Fed over the last 6 to 9 months, right? Before the end of 23, we were anticipating anywhere from 4 to 5 cuts over the course of the year, starting as soon as March of 24. Past that, now we're talking about maybe 1 cut late in the year. I think there probably will be a Fed rate cut, barring some unusual data, strength in inflation, spikes in CPI or other things that could scare the Fed. But very likely it'll be a cut, but I think it'll be late in the year. And I think that's because the factors that the Fed are watching, the Fed, governors are watching, are slow moving. And the trend has just, in the very recent past, shown a little bit of softening of inflation and pressure on prices. But the general trend over the last 6 to 9 months has been tighter policy, probably needed rather than softer, more dovish policy to keep inflation down and maybe bring it kind of that last difficult 0.5% to 1% from 3% to 2% that the Fed has targeted. So I think it's going to be later in the year. I think it'll be less in 24 than we all thought 6 to 9 months ago. Another aspect of this that may be a factor is the election cycle. We have a major presidential election in November. I think it's not coincidental that we're expecting the Fed to maybe do something very late in the year, maybe to show impartiality, that they're not really trying to affect the outcome either way.
After the election,
inflation and high prices is a big factor in how voters are going to turn out at the end of the year.
Yeah, late in the year, meaning after November, not necessarily before the election, in terms of indicating that they're tipping the scales one way or the other. You mentioned, tough to keep inflation down was one of the phrases you used there, right? When you see copper at all-time highs, and it's come off that level, but gold recently at all-time highs, right? These kind of factors that feed right into a crude recently coming off that $80 level as well. I mean, it's helped, but again, still at stubbornly elevated levels. You also talked about change as far as expectations in terms of rate cuts, right? Going from that 6 to 3 to maybe just 1 right now. I mean, you just said last week we were talking about the possibility of a rate hike, according to Kashkari. That's not off the table yet. But talk to us a little bit about central banks and some of the trends we've seen there with gold buying. As we see these changes occurring, as they start to get a little bit more in a cut cycle, do we see some of those trends changing? Because that's been a big part of what's supported gold prices, right? Was that demand for gold from some of these central banks?
Yeah, absolutely. I think it makes sense for central banks to short their reserves. Most countries are not in that amazing position that countries like the U.S. and China are, and they have to be more defensive, think more, I guess, proactively to how to defend their currency in their much smaller economy. So building up, foreign cash reserves, foreign currency reserves, and building up precious metal reserves makes a lot of sense. It's been a very interesting, 2024, and maybe even more importantly, Q2, because this rally, we saw gold break out of this 2,000 kind of range very solidly, now up to 2,400 an ounce. We saw silver break out. It was having difficulty breaking above $25, and now it's kind of solidly above 30. But we saw that same thing translated to industrial metals. We saw it in copper, and we saw it also in aluminum. And copper broke through $5 a pound not long ago, as you said, just an incredibly high price for that metal. I think it's interesting that it's happening across precious and industrial metals all at the same time in a kind of, a 3 to 6 month period. And one of the things that I've reflected on is that, metals are very different from energy and grains. Grains are down maybe 5 to 7% this year. Petroleum as a sector is maybe only up 5%. So you've seen the best strength in metals. But metals, there is no shortcut. There's no hydraulic fracturing and horizontal drilling to extract metals faster. There's no acceleration to that process. And at a recent industry conference of copper, one of the comments from everybody from the Department of Energy to the Chamber of Commerce was that the permitting process is just still too slow. And one of the things that's a bias against mining and expansion of mining and mining permitting is the environmental aspect. We associate like mountaintop strip mining or the kind of old-fashioned gold mining that you had huge pits of acid to further refine ore that had been extracted that were environmentally dangerous. They were hazardous. That's associated with mining kind of in general, and it's really holding up the process of moving towards expansion of rare earth mining, expansion of copper mining in the U.S., which ironically is holding back the acceleration into this new energy transition and renewable energy, electric vehicles. That's going to slow us down because we're going to need huge amounts of those resources to carry this economy forward in that transition, regardless of whether it's expanding or contracting. I think that move is going to happen. And so I think it's quite interesting that we've seen this kind of pan metals rally. And that's one of the things that they have in common is that there's no shortcut. It takes billions of dollars and years to open a new mine.
Yeah, we've talked a lot about that, and it has been an interesting 2024 in terms of some of those factors and all of that ultimately feeding into the discussions we've had associated with the Fed, right, and the inflation component, AI, and the demand narrative that's been playing out here. Let's kind of circle back because we started talking about, right, how we mentioned central banks were the predominant theme at the beginning of our show here this morning. Also the indices we were talking about to new all-time highs, right? And, as you were saying, talking about grains, it kind of made me think about, okay, while we've seen metals, we've seen energy prices at stubbornly elevated levels, yes, off recent highs, but still at stubbornly elevated levels. Grains, for the most part, in many ways, now rallying off recent lows, have kind of provided a bit of a balance, right, to that inflation narrative in many ways. And that, I feel like, is kind of tying back to one of the things that the market really likes is, again, energies, metals at stubbornly elevated levels tied to some of the demand we're seeing, but grains helping provide that balance.
That's right. I was commenting with someone on global conflicts, and we've spent a lot of time thinking about what's happening in the Middle East. Is Iran going to get pulled in through Hezbollah in conflict between Gaza and Israel, and so on, or Saudi Arabia? But we forget about Ukraine and Russia. This conflict has still been simmering. It's now in its third year. And we forget about how critically important it is as the breadbasket of the world, creating large amounts of wheat, huge amounts of wheat on the global marketplace, but also significant amounts of corn, sunflower oil, which is a big, oil seed, and others. And that conflict has not resolved. And, when you think about grains on a global basis, I think that it's easy to overlook the fact that that is still unresolved. In fact, maybe entering a more dangerous phase as both Ukraine and Russia are getting a little weary and looking to try to wrap this up or end and push for a positive resolution to the outcome. I don't know if it's going to be peace. It doesn't seem to be on the table. The Black Sea Grain Initiative that was brokered early in the conflict ended in the summer of 23. And it ended, Russia pulled out, said, we're not going to allow the safe passage of grain out of these Black Sea ports controlled by Ukraine, and immediately started bombing Odessa and hit a couple ships that were loaded with grain. They've since, earlier in 24, resorted to bombing and targeting Odessa again, and actually hit some factories holding grain bound for the Middle East and Africa. So I think it's easy to overlook that conflict and its impact on global commodity prices, especially grains, and it's still sitting out there.
Yeah, I would argue we haven't overlooked it, but we've definitely, I feel like, become callous to it. And we were talking about that months ago, right? And kind of to that point here, I feel like, dating back to February, what was it, 24th, I think, of 2022 is when Russia invaded ultimately. And so here you said an interesting 2024. I would argue an interesting 2022, 2023, and 2024 now as we focus on these commodities again and the influence they have on this inflation narrative. Kurt, appreciate you joining us here. Solid discussion, and look forward to having you back to follow up. Kurt Nelson, founding partner. Thanks to you, Kurt Nelson, founding partner and CEO of Summerhaven Investment Management.